Everyone. I welcome you all to the second part of what we started the other time, adjustments to trial balance. We're concluding this particular moment. My name, once again, is Obafemi Oyewumi. So we're looking at adjustment to trial balance, part two. Recall that yesterday we talked about accruals. We look at how to adjust for accruals, talking about accrued expenses and accrued revenues. And then, of course, we also look at deferrals, talking about prepaid expenses and at the same time unearned income, unearned revenue. So today we're looking at the other adjustment to be made to final accounts. That's talking about adjustment to be made to trial balance, and we are starting with bad debt this particular moment. Now, what's a bad debt? A bad debt is that portion of debt that is irrecoverable. It is part of the account receivables that can no longer be recovered as a result of maybe several factors. It could be as a result of the death of the owner of the debt. Okay, it could be as a result of bankruptcy. It could be as a result of disappearance of the person that owes such an amount of money. So as a result, such an amount should be written off the respective debtor's account at the end of the accounting year. So what are the adjustments to be made when you discover that a particular debt has gone bad? Number one adjustment you have to make is to debit your bad debt account, okay, and credit your account receivables account, which is also the debtor's account. So at the end of the year, the second adjustment, while preparing the final account, the bad debt account is transferred to the income statement, by passing and following an adjustment. That's debiting the income statement and of course crediting bad debt account. Okay, so let's look at this example. We're talking about Garbage Electronics Limited has 5,450,000 standing as account receivables in the entity's trial balance as at 2020 financial year. It was discovered that one of its debtors, owing the sum of 254, had been declared bankrupt. The amount standing in the bad debt account in the trial balance as at 31st December 2020 was 224,500 naira. How will this be treated? Okay, so the adjustment to be passed, number one has to do with the fact that you have to write off the bad debt amount. So you debit your bad debt account by 254,000. Okay, debit it with 254,000 and then credit account receivables with 254,000 as well. So, and we have the narration, there be additional bad debt written off. Recall that a particular amount was standing in the bad debt account before. How much? We're talking about 254. Okay, 224,500 standing in that same account before now. So we need to write off the additional debt that you have discovered to be bad. So let's look at the effect. In effect, the total amount to be written off at the end of 2020 financial year is the first one, bad debt balance as shown in the trial balance, 224,500, and then the additional bad debt to be written off now is 254,000. So at the end of the day, you are writing off 478,500 naira. So that is the bad debt that has to be written off at the end of the financial year 2020. That's all about bad debt. Now let's go to depreciation. Depreciation. What is depreciation? Depreciation is the systematic allocation of cost of non-current asset over its useful life. It's a way of matching cost of non-current asset with the revenue or other economic benefits it generates over its useful life. When a particular non-current asset is bought, it has a particular number of years, useful years, that you have to make use of, or you have to be generating income. At the end of it, then you can say, okay, you have a scrap value or residual value. So in order for you to match your income with the respective cost, one has to also factor in the cost of wear and tear of that particular asset. So depreciation can be described as a reduction in the cost of tangible and depreciable assets used for business purposes during certain amount of time due to usage, passage of time, wear and tear, technological outdating or obsolescence, depletion, inadequacies, rust, decay, and other factors. Okay, other factors. All right, so that's talking about depreciation. Now, there are several methods that one could use when it comes to depreciation. The first one is straight line depreciation method. The second one is reducing balance method of depreciation, and then the final one is sum of the year digits, okay, method. Let's look at the first one, straight line depreciation method. Straight line depreciation method estimates the salvage value of the asset at the end of the useful life and expends a portion of the original cost in equal installment over that period. We're saying that a particular portion is, I haven't estimated the salvage value, the residual value. Okay, a particular portion of the cost of the asset will be taken and be taken out of your income statement every year throughout the lifespan of that particular asset. All right, so that's depreciation using straight line method. Let's look at the computation. How do you arrive at it? Now you look at the annual depreciation expense. How do you arrive at it? You have to deduct the residual value from the cost of the fixed asset, the cost of the non-current asset, okay, and divide it by the useful life of the asset. Okay, cost of fixed asset minus residual value you and over divided by useful life of such an asset. Let's look at this illustration. Illustration one said assume that a vehicle depreciates over 5 years. It is purchased at the cost of 170,000 and is expected to have a salvage value of 20,000. Calculate the depreciation charge. Calculate the depreciation charge. So what must you do? Ascertain first the depreciation charge per annum. Okay, and that's like we did earlier on, that we showed to you that the formula cost minus residual value divided by number of years. So here we have 170 as the cost, residual value 20,000, and then 5 is the number of years. So we have to divide it by the difference, and that will give us 30,000. So that means that the depreciation charge per annum is 30,000. So this is the amount that will be taken and be charged to your income statement as an expense every year for the next 5 years. Let's look at the second method, sum of the year digits method. Sum of the year digits method. Sum of the year digits method is a depreciation method that results in a more accelerated write-off than straight line method. Okay, so under this method, annual depreciation is determined by multiplying the depreciable cost by a schedule of fractions. Okay, so we have depreciable cost as original cost minus the salvage value, book value, that's the original cost minus the accumulated depreciation. Okay, so some of the year digits talks about all the digits in all the number of years to be that the asset will be made use of. Now let's look at this illustration, the number 2 of it. If an asset has original cost of 100,000, a useful life of 5 years, and a salvage value of 0, compute its depreciation schedule using the sum of the year digits. What are the steps? So number 1, determine the year's digits. Okay, that's saying you have 5 years. You begin to count. How many digits do you have in 5? Will you list number? We list 1 to 3 to 5. Then how many digits do you have? So you start with 5, 4, 3, 2, 1. So 5. So next you have to calculate the total. So 5 plus 4 plus 3 plus 2 plus 1, making it 15. So fractionalize the rate of depreciation by placing each digit on the total, beginning from the highest. Okay, fractionalize the rate of depreciation by placing each digit on the total beginning from the highest. So that means that for the first year you have 5 over 15 like we have here. The second year we have 4 over 15, and then the third year you have 3 over 15, and then the fourth year you have 2 over 15, and then the last one you have 1 over 15 for the fifth year. So once you know the salvage value, which we already know has to be there is no salvage value in this case, 100,000. So 5 over 15 will give you 33,333 naira, 33 kobo. And then this 4 over 15 will also give you 26,000. Okay, 26,000. That's what it's going to give to you. 26,666 naira, 0.67. all and just like that until you get to the final. So at the end of the day, you'll be having 100,000 as the amount being to be written off over the 5 years of the lifetime of the asset. Okay, so that's the other one there. Let's go to the next method. This one is called reducing balance method. Reducing balance method. Now, this is another depreciation method that provides for a higher depreciation charge in the first year of an asset life, and gradually decreasing charges in subsequent years. Okay, so what this one is trying to say is that, look, you have to give accelerated depreciation. At the beginning, you charge more, okay, and then towards the end of the lifespan of the asset, you charge less. Okay, so this is more realistic reflection of an asset actual expected benefit from the use of the asset, because many assets are most useful when they are new. Let's look at the way to go about this. Annual depreciation, okay, is determined by multiplying the depreciation rate by the book value at the beginning of the year. By the book value at the beginning of the year. So when we talk about the book value now, we talk about the cost of the asset minus the accumulated depreciation. So every year the book value changes, and you multiply the value by the rate of depreciation. Okay, let's look at this example, illustration 3. Suppose a business has an asset with 100,000 as the original cost, 10,000 salvage value, and depreciation rate of 40,000 or 40% rather. What is the depreciation charge for the first 5 years? Okay, so let's look at it here. The first one is 100,000. That's the cost of the asset. The value, the salvage value is 10,000, and then the depreciable value is 90,000. Now let's now look at what the picture will give us. So depreciation value 90,000 divided, multiplied by 40%. That's what you have it now. 40%, that's the depreciation rate. 40% is 36,000. So deduct this, you have 54. So the next one, the second year, 40% of 54 will give you this. Okay, at the end of the day, you also deduct it from the balance that you are bringing forward, taking forward, per year, because every year now it keeps reducing and you keep applying the amount, the division rate to it, till it gets to an infinitesimal figure. So that is just what we have there. Now let's go to the next phase of this particular class right now, the lecture: accounting for depreciation. How do you account for depreciation? Put here that depreciation cost is not to be taken out of non-current asset directly. Okay, instead a contra asset account is created. What this contra asset account is: an asset account with a normal credit balance, typically called accumulated depreciation. Okay, typically called accumulated depreciation. So what we're saying here is that you don't remove the cost, the expense from the cost of the asset. What do? You create another account, asset account, but this time around, this asset account has, okay, a normal credit balance. All right. So you record depreciation expense that will involve a debit, to an expense account called depreciation account, and then the corresponding amount will be credited to the accumulated depreciation account. Let's look at this illustration once again. We used something earlier on talking about reducing balance method that we had earlier on, 33,000, 26,000. Remember that? Okay, so we are coming back to that again. Now this is a depreciation expense account. Depreciation account. Okay, this is the expense. All right. So and we also have another account, accumulated depreciation. Accumulated depreciation. So what do? For example, the first year then gave us 33,000. The first year gave us 33,000. That's what we have at 33,000. All right. 33,000. Then the second one 26,000. The next one 20,000. Next one 13,000. So let's look at how the thing will look like here, in our accounts. All right. So depreciation for the first year, 2015, we have a debit to depreciation account, a debit to RE, and then a credit, corresponding credit goes to accumulated depreciation account of 33,000. Okay, the same amount. All right. So at the end of the year 2015, this value 33,333 naira 33 kobo is taken out and transferred to the income statement. okay, as a charge. So it's being credited here. The corresponding debit will go to the accounts, that's the income statement, okay, income statement for that year. So the same thing you do for 2016, 2017, 2018, 2019. Okay, now let's come back to our accumulated depreciation here. Now this one is not written off because it's an asset account, but just that this one has a corresponding, a normal credit balance. So here we have for the first year 33,000, okay, and that's what you have. So you have 20 for 2015 33,333, okay. So balance brought down is 33,000, the same amount. Now depreciation expense for the second year 26,000 is also brought here. That's what you have, this figure, here. All right, so add the two together gives you 60,000. Okay, 60,000 is also taken and carried down, and you have it as balance brought down. The depreciation charge for 2017 is 20,000. You add it to it, just give you 80. Okay, that one also carried down and then brought down here. Okay, and you have to depreciation expense for 2018. Okay, which we have been debiting to the different years in the depreciation expense account. So you also have 93,000 as the balance, and then it's also brought down. So on and on until you arrive at the last year and you have 100,000. So it means that at the end of the fifth year, this particular asset has been fully depreciated, So that is the way to account, for it. Now let's go to the final concluding part now. Disposal of non-current asset. Disposal of non-current asset. Now, non-current assets are not meant to be sold ordinarily, but nothing says that an entity, could not sell, his own asset. So saying that non-current asset may be sold anytime during their useful life. It will amount to removing the asset from the balance sheet and recognizing any resulting gain or loss in the income statement. So when you sell a non-current asset, you either have a gain or loss. That means sold at gain or at a loss. So the accounting for disposal of non-current asset can be summarized as follows. Okay, now record cash received or receivable created from the sale. Now, when you sell, you receive cash. Okay, so what do? You debit the cash account and credit asset disposal account. So that means you're going to create an asset disposal account for this purpose. All right. So you remove the asset from the balance sheet. That's the step 2 by crediting non-current asset with the the cost of the asset. It shouldn't be the net book value, but the cost of the asset, and then you credit the asset disposal, okay, again, from that particular transaction. Okay, you credit the asset disposal, then you recognize the resulting gain or loss. Now we use net book value here because we didn't bring in the depreciation element. So if normally the depreciation element should also come, so you take away the cost from the asset, you also remove the accumulated depreciation from the accumulated depreciation account. Okay, so let's look at our illustration in question 5. Okay, illustration 5 that we had earlier on, and assume that the company sold the asset on January 2nd, 2018. January 2nd, 2018. Remember that we had, a reduced balance method that we used then. Okay, we're saying now that let's assume that the asset was eventually sold on January 2nd, 2018. So, and it was sold for 35,000. So what will it look like in a ledger account? Now we've seen the steps to be taken earlier on. Okay, now we are going back to the question. Now let's see how it goes. So asset account is created for that particular asset. Of course you have your non-current asset. So now you have a balance brought forward, assuming that okay, this was the only asset. Now if there could be other assets that will form part of your asset account. So what means that the element will also already be part of that portion will also already be part of the account brought forward. So you have disposal account because the 100,000 is taken out because you sold the asset. So 100,000 is taken out, and of course you debit your disposal account. All right, so accumulated depreciation. So you have a balance brought forward, as at the year 2018, the total amount standing in the accumulated depreciation account was 80,000. So you have a balance brought forward of 80,000 on the credit side, remember, and then you move it out of it, and then you take it to disposal account by debiting your account accumulated depreciation account. So you come to your disposal account, and its value is also there, the corresponding entry. Now let's look at the cash that came in as a result of the sale or the disposal of the asset. So you have cash account, I call it extra because this is not the total picture of the cash account. So 30,000 came in, so you debit your cash account and then you credit disposal account as well with the value that's 35,000 naira. So you add everything together, this 115,000 naira. Now, at the end of the day, there will be a balancing figure. Okay, there'll be a balancing figure of 15,000. So the difference between 100,000 and the 115 will be your balancing figure. And in this case now, it is a gain because this one will also be credited to your income statement. When you credit your income statement, it means that you've already made a gain from the disposal of the current asset, non-current asset rather. So that is coming to the end of adjustments to trial balance, as it were. So been able to look at the other adjustment that we had in the other class. We talk about accruals. Okay, we also talk about the deferrals, and now we have also covered the other adjustment to be made to your trial balance. I believe that we have been able to take something from this particular lecture, this particular class, this particular moment, and it's my belief that whenever any question comes from this, you'll be able to actually, as much as possible, provide solutions to them so that you'll be able to display a good knowledge of this particular aspect of accounting. Thank you for being part of it. Don't forget to subscribe to this particular channel because other videos will be also be dropped here, as time goes on. And of course, like it, share it with your friends and colleagues so that they will also be a beneficiary in the whole knowledge that's being shared here. Thank you very much for being part of it once again. God bless you.